My background is in consulting, so I've been with Standard Life now just over 2 years. And I think I basically joined Standard Life with a single mandate, really, which is to help transform the way that we think about default investment design. And Standard Life, certainly as part of Phoenix Group, had strong ambition to do that, working very closely with our Master Trust, of which really pleased to see Helen here keeping tabs on what I'm saying. But yeah, back in consulting space, so my background was in wider than just DC, local government pension schemes, defined benefit schemes. And I think one of the kind of key learns I've got in terms of the DC market, having sort of moved more towards that, say, from about 6 or 7 years ago, is that DC market really requires institutional focus on investment quality. We still have kind of hallmarks of retail grade investment solutions. And I think when it comes to considering the opportunities that private assets do genuinely present, we absolutely need an institutional quality lens on that. We can't try to morph the opportunity into some kind of retail grade solution. And that's where I think, to summarise some of the comments I'm about to share, I think I'd probably package it up into, I think instead of trying to make private assets work for DC, we need to make DC work for private assets and the wider opportunities. So what are those opportunities? Well, first and foremost, I think with our esteemed colleagues on the panel, they will cover in more detail. But generally speaking, the well-tried and tested message at this stage is there are opportunities for long-term investment growth that is vastly superior to the opportunities that exist in traditional listed and liquid markets. We can point to overseas regions for evidence of how those opportunities have been captured very well in Australia, in Canada, and in the UK, local government pension schemes, private sector defined benefit schemes. So historically, defined contribution savers have missed out on anywhere from 1.5% to 2% per annum over a multi-decade time period of returns. So there's an opportunity missed there, and I think a real imperative for us to now push. Does that forward-looking case hold? Well, I think it absolutely does. There will be challenges over the short to medium term, but the long-term case remains. And this is therefore a duty for us to understand how we embrace that. So long-term return potential, I think it's then in the manner in which we pursue those opportunities, both in terms of the UK and globally, material level of change and evolution. We're going to evolve into a completely different world in the future. That presents risks and opportunities that will be predominantly accessed and influenced through private assets and private capital investment. I think from a UK context, the piece that from my perspective doesn't get discussed enough is if, for example, we successfully modernise and reform the energy infrastructure in the UK, we can put people in a position where they've got cheaper energy bills in retirement. And that's just one issue that we can influence in terms of the wider outcome. And I don't think it gets discussed enough through that long-term lens. Of course, there are risks to get there. The main risk that's discussed is liquidity. But I think the DC market today is about 650 billion, something like that. By the end of the decade, it should be well in excess of $1 trillion. The pension schemes bill opens up the roadmap for super funds or larger default funds. So scale's not an issue. Vastly positive in terms of cash flow through the benefits of auto-enrolment. So cash flow is not an issue either. So the challenge is putting the liquidity to work, not managing illiquidity. And this is where, this early stage of our industry trying to tackle the problem of how do we access the opportunity, I am seeing hallmarks of retail grade solutions where private assets are packaged within a kind of a liquidity considered solution. Ultimately, what that does is deplete the outcomes potential for pension savers over the longer term. That's not the direction that I would support. I think the other dimension we are influencing and we really need to change is that we do not have regulatory parity in the UK. So we have multiple regimes, multiple sets of rules, and that means, one, we've got the possibility of different treatment for different groups of individuals in the UK. But secondly, and I think most importantly, it does impact on the quality of the investment opportunity. So to give an illustration, I know that Paul will come on to this in more detail, I'm sure. If you take private equity as a market today, 90% plus of private equity funds globally have a performance fee as part of the fee structure. So not creating frameworks that accommodate performance fees means risking eliminating 90% of that mature market, which presents a risk to pension savers. So I'd say that regulations and rules today actively create risk in terms of pursuing outcomes. And we know that there is a massive range of outcomes that we can expect to experience when investing in private markets, particularly in private equity. And we want to be at the upper end of that range, or set ourselves up to be at the upper end of that range. There's a real risk that through the rules that we have today, that we create the conditions for pension savers to be at the lower end of the range. And that's what I'm worried about. That's what I'm seeing elsewhere in the market in terms of some of the solutions. Coming back to my original point then, where I'll wrap up, again, I think the duty that we have is to make DC work for the investment opportunity, work for outcomes, and not try to get DC to fit, not to get private assets to fit within the rules we have today. So that's where we're pushing hard.
I don't agree with government or ministers directing on investment in pension funds in any way, shape or form. I should be upfront about that. I don't think governments or ministers can maybe nudge and suggest, but I think to try and force or squeeze a proportion of funds into particular sectors, I think it's dangerous. And I think it's dangerous mainly because of my political experience. People have different perspectives on what is a good investment and what is a bad investment. So in Australia, you know, if you let loose our National Party, which is a country party, you know, rural regional, we'd be putting money into, you know, roads to nowhere and, you know, all sorts of exotic non-return. So I'm very, very clear about government should not direct and should not have that power. They should not have that power. It's the trustees' fiduciary duty to maximise the return, diversify for members. And the truth in Australia is I think the reason we're further down the pathway of private unlisted private equity, a couple of key reasons. Firstly, Australia started its defined contribution system a lot earlier than almost any other country, 1987. Switzerland was actually the first, but that's another cultural world of pensions. So 1987, early starters, compulsory. So you had a rapidly building DC system, and that's very different even from the UK today, where we are 4.2 trillion Australian dollars, growing at a rate, we'll overtake Canada. We're the 12th largest economy in the world. We have the 4th largest DC compulsory system, growing at a very rapid rate, partly because we've got a younger population profile. Secondly, very substantial migration. Migration, job growth, drives a DC system. And that's little noted in the growth of the Australian system.
Important to say that is sufficient liquidity to facilitate the natural ebb and flow in a pension portfolio. It's not sort of liquidity designed to facilitate tactical asset allocation decisions. How you deliver that liquidity in a long-term asset fund is key. The market typically offers you a product where the liquidity comes through low-cost, passive index equities. But you're paying private market fees for this private market fund. So does it make sense? And you're also acquiring more public equity exposure you already have in the other part of your portfolio, so it's not completely complementary. So thinking about that, we thought we would do it differently. So we structure cash flows, structure liquidity into our portfolios through the assets we invest in very carefully.
2 points, if that's the case. One on the level of allocation. I mean, clearly, as we've heard from the panel, definitely share this view, quality really counts. So a relatively smaller allocation to genuinely high quality private assets with institutional rigour and grade around it could provide a better outcome than a larger allocation overall to private assets, but where the quality is diminished through the structuring of the solution, as we've seen in the market already so far. Where we are trying to go in terms of Standard Life is do both. We want to maximise quality and the allocation. I think where we should be open-minded to see in terms of future pathways, allocations of 25% or more in DC defaults. The conditions are there to support that, but implemented in a really considered way. So it's not private assets tomorrow tick. We've ticked the box of private assets. We're going to be able to compete where there's interest in those solutions. It has to be at the right quality level, and starting from zero building over a number of years' time as we navigate what's probably going to be a more challenging cycle in terms of private equity valuations in the short to medium term as well. So very much long term. On the race to the bottom, I think that, Stephen's covered that largely, and he is the one solely, along with Mark in the room is here as well, navigating that in practice in that intermediary space. One piece I would maybe share is it's learning from Australia again. Compare the pair.
Yes.
You remember this? So we had a little tour to Australia last year to learn on the ground, what is it they do differently? What is there that can be considered and perhaps integrated in the UK, what can't, for various reasons. One of the areas that we sort of took away was this Compare the Pair campaign of superannuation funds. It was a series of adverts that genuine average individuals on the street would be chatting about the returns they've had from the super fund. One super fund's delivered 10% per annum, the others delivered 12% per annum, and so on. I think we need that kind of mindset here, but it has to be with the right time frame in mind. So the challenge, I would say, is if we kind of generally agree that default design today is not optimal, and there are different directions that we could go in here. We talked about private assets. Over the longer term, what is the conversation you want to be having with members in 20 plus years' time? Do you want to have the conversation with a member to say, your return has been 7 or 8% per annum over 20 years or more, pretty good, and by the way, we've done that with keeping charges nice and low for you as well? Or do you want the conversation to be, we've delivered 10% plus per annum, and your retirement outcome is a third better, so you're going to have a much better lifestyle in retirement. And by the way, it did cost a bit more to get there. They're going to tell you they don't care about the cost, they never saw it. They're not paying for it now. They pay for it in terms of their outcome over the longer term. So we need the lens of 20 years plus to drive the decisions, not basis points.